Hey guys, AKIL'S here. Welcome back to the Trading Coach Podcast, another video episode for you. So if you want to head over to Spotify and watch this or YouTube, you can. For you guys that are new to me on YouTube, I do the video versions here on podcast, but the other episodes you can catch on your favorite podcasting app 3 times a week. I just encourage you to take the 10 episode challenge, which means go back, find 10 episodes that look cool, give them a listen, then make this a normal part of your routine. Today, we're going to talk a little bit about drawdowns and why they come so quick while the glorious times seem to take forever. And we'll dig into why that is. But I want to give you a little bit of background of how this conversation started. This has been a very busy week of fundamentals, as we call them, in the market, right? We've had monetary policy decisions from Bank of Japan, from the FOMC here in the US, from the Swiss National Bank, and then finally this morning from the Bank of England. So I expected a little bit of a dullish type of week because I'm not really interested in trading through these events. Yes, the week has been slow and boring. I've only taken 3 trades this week, but all 3 have been winners and I'm up 5%. Now, for you guys that are new to the podcast, we have realistic expectations here, right? This is not one of those shows. I'm not one of those trading gurus that says you should be making 5% a day every day, because if you just do the math on that, it's not really realistic. If you did, you'd be the greatest trader ever in the history of Earth and probably the solar system. So 5% in a week is fantastic for me. Shoot, if I can make 5% on a month on average, that's a 60% year. My best year was about a 60% year, so I will gladly take that. The point is, it's been a very good week, and as we came on to the Tier 1 trading platform today, I was talking to a few other traders who were also having good weeks, and they were talking about, hey, they're closing down shop, right? They're exiting their position before the Bank of England announcement because they don't want to give themselves any opportunity of giving that profit back. And it reminded me of an old stock market saying, right? Where the bulls take the stairs and the bears take the window. And what that means is this, right? When you take the stairs, imagine you're entering a big, large Wall Street building and you're on the 50th floor, because that's where all the important stuff happens. When you take the stairs, it takes a very long time to get to the top, right? Just like bullish trends, right? Uptrends, imagine like the S&P, for example. Maybe I'll show a chart in front of you on the video version of this. The S&P, right? It just steady Freddy. It slowly kind of goes up historically over time. However, when it comes to bears taking the window, if you were to jump out a window, and please, disclaimer, Akil is not encouraging you to jump out windows. That would not be a good idea. But if you were, you would fall to the ground pretty quickly due to this thing I learned about called gravity, right? And that's how kind of bear markets are, or crashes are, right? Bull markets go forever. They're slow and boring and no one really cares about them. But crashes, boom, they come right away. And again, you should be seeing a chart in front of you for you guys watching the video version of this, kind of visualizing what I'm talking about. Now, the reason this is because of our expectations as traders, and not just traders, but kind of the general public as well. We are conditioned to expect the good. The good is normal, right? So the stock market rising slow and steadily is a normal thing. Think about your average investor that just has like a retirement account, right? How often do they check that retirement account, right? Once a year, maybe, right? Right before tax season, maybe twice a year, right? But not that often when things are going well, right? So if the news isn't talking about anything horrible happening, everything's good. It's supposed to be good. My money guy told me it's supposed to be good. So let's just let it ride. But as soon as things go bad, and I've spoken to a lot of bankers who they hate when this happens because people always overreact. As soon as things go bad, when we see a sharp decline, all of a sudden, everybody is a financial expert. Everyone is checking their funds. Everyone is checking their portfolio, seeing what they have. Everyone, if it gets bad enough, is making a call saying, hey, you got to get me out. You got to get me out. You got to get me out. And it's this massive panic, right? Not thinking about the bigger picture. So we tend to value the negative times a lot more than the positive times, right? It's kind of like pain and pleasure, right? The 2 emotional drivers that we have. Everything that we do as human beings is either based off of how can I gain pleasure or how can I avoid pain, right? If we had to choose one of the 2 of being the higher motivator, it is avoiding pain versus gaining pleasure. So we always give pain that much more energy than we do pleasure. Pleasure is kind of expected. Pain is scary and new, and we want to avoid it. Now, we were speaking of this not from just an investment perspective on the platform this morning, but from a drawdown perspective, because it's the same way as a trader when it comes to drawdowns. Now, if you're new, a drawdown is a period of time where you lose money, right? The simplified version of it is you lose money during the drawdown. And what happens is for a lot of traders, just like an index, their hot streaks or their periods of growing their capital is kind of slow and boring. They expected, hey, winner here, winner there, blah, 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 blah. But then when those drawdowns come, those drawdowns tend to be pretty quick. Those drawdowns tend to be pretty powerful. And the question is, why is that? And the reason is again, we're bringing that drawdown, or we're giving that drawdown more power than it deserves, right? Losses are normal. But when a loss comes, many traders think that we did something bad, or many traders start getting emotional around it. And that's what we're going to dig in a little bit, why that happens and what you can do to kind of cure that. And those emotions kind of, escalate things, and things get worse and worse and worse, right? A couple episodes, I shared with you the belief cycle, right? Belief, action, results. And I told you about two ways that can go. The positive way, where we're building confidence and we're getting better as traders, and the negative way, where it snowballs and it destroys everything in its path. A drawdown is a regular snowball just sitting, existing at the top of the hill. An emotional driven drawdown is that little bad kid that pushes that snowball, and it gets bigger and bigger and bigger and destroys the town. And I can tell you in personal experience, I used to do this a lot, where I would have months of hot trading, meaning I've had good trading for 2, 3, maybe 4 months, and I would give it all away within a matter of weeks. And it's all because I would have a loss, I would panic, I would try to get revenge, and it would escalate, and I would end up thinking I'm fixing everything or making up for stuff, and I would just make the situation worse, and I'd have like 3 straight good months of trading ruined by 1 bad week. And it was the most frustrating thing possible, because I didn't know how to feel. I felt good that I was winning for 3 months, but then I felt bad because I had nothing to show for it. And I was kind of stuck in this trading limbo of not being confident and being really confused. So the key is, right, into surviving a drawdown is eliminating that emotional response. Let's talk about that a little bit. The main emotional response that we get from losing is revenge. Revenge is the main thing, or the main emotional response that causes us to take negative emotional reactions is going to be revenge. We have a trade, we anticipate it winning, it doesn't win, we get angry, and now we got to get it back right away. I got to get revenge, right? Similar to that story of the guys that stole my basketball court, and I went over there to get it back, and it did not end well, right? See how we're pulling back on all the fun old stories that we spoke about? You guys liked that episode, right? Hearing about AKIL getting kicked and stomped was fun for you guys, right? But anyway, so let's talk a little bit about this revenge. And before we can talk about the solutions of revenge, let's talk about why revenge happens. And there's a few points I want to focus on. Realize that revenge is an emotional response. It is nothing more than a distraction from whatever our underlying suffering is. Now, we don't know that, but this is the truth. Meaning that when we think about revenge, or we take action to get revenge, pretty much we're just avoiding the problem that actually exists. In our minds, we think that we're taking an action to make things right, but the truth is the action that we're taking is just fueled off of fear. It's powered by anger. And the reason that we're doing it is because we want to feel powerful. We want to feel in control. And by doing something to take action, that makes us feel that way, like we are in control of the situation. The problem is we aren't actually in control of the situation, because what we're trying to get revenge for already happened. It existed in the past, and no matter what we do, we cannot make up for the past. So there's only one option. We can affect the future. And typically when we are in a revenge state, we aren't thinking clearly, we're not following our rules. More times than not, because again, sometimes you can just close your eyes and throw money at the market and it will make you money, right? But more times than not, it's going to lead to a worse situation, which is just going to want us, if we can't shut it down, it's going to lead us to taking more revenge. And again, that snowball is going to get bigger and bigger and bigger. So we have to understand that nothing that we will do in the market will make up for what has already been done. So what's the solution? Well, the solution is we need to find another way to distract ourselves. Again, this revengeful response, although we think it's the right action, this is nothing more than a distraction, right? We are living with something that happened. We don't want to admit that it happened. So we're putting ourselves in a position where we can focus on something else and instead of thinking about that. We need to distract ourselves and control that emotional state. And what this means is we still need to find a way to release anger. We still need to find a way to feel powerful. We just have to do it in a more productive way. Something I personally do after every one of my trading days, right? Good day, bad day, neutral day, is I plan my physical fitness. I plan my workout directly after my trading day is over. And the reason I do that is because that is when I am the most emotionally vulnerable. I guess aside from like being in a trade and watching it tick up and down, right? But I am most emotionally vulnerable directly after my trading day because I'm either hyped up from a good streak of wins or I'm depressed after a bad streak of losses, right? I don't actually get this way, but this was me in the past, right? So something I did was I started going for bike rides. I started going for runs. I started going to the weight room, to the track, whatever I was doing at the time, boxing. I started doing that stuff directly after my trading day was over because it gave me that release. Whatever I was feeling inside of me, I got that release out of my system. And that way, when I returned to my charts later in the day, I was kind of fresh and not carrying that baggage with me. Now, when it comes to having power over the markets, I mentioned earlier, we don't have any power over the markets, right? The markets will do whatever they want to do whenever they want to do it. And we need to come to grips with that, right? What we do have power over, however, is ourselves. We control our actions, we control our responses. So although we can't control the outcome of an individual trade, although I can't control what happened on a previous trade, I have 100% control over how I handle the next trade. Again, not the outcome of the next trade, but the situation that I put myself in. If I am in revenge mode, I am purposely putting myself in a situation where I am more likely to lose money than gain money, right? So that's a negative situation. But by having power and not taking revenge trades, by taking trades that only stick to my plan, I'm putting myself in a situation where I am now back in control of my edge and I have more chances of winning versus losing. And that's me taking control. That's me having power. But going back to the basics, you're saying, Akil, all these solutions are good, but how do I stop myself from feeling angry in the first place and getting into this state, right? Well, it comes with having proper expectations, right? Going back to the bulls, stairs, bears window, right? We shouldn't necessarily expect for everything to be happy-go-lucky in the market all the time. We shouldn't necessarily expect to panic every time something goes a little bit wrong. We need to have the right expectations, and these come in two different ways. One, bigger picture, we need to have a bigger idea of what our trading is like. I saw this cool tweet the other day. It was from my buddy Moritz over at Tradeciety and EdgeRonk. He says, a winning trade takes zero skill. 5 winning trades in a row takes zero skill. 50 winning trades randomly distributed over 100 trades interspersed with losing streaks and with a positive expectancy, for example, 2-to-1, or a better risk-reward ratio takes a lot of skill. That's why trading is hard. And what that means is that we can randomly win, we can randomly lose in the small picture. But the big picture, right? It takes a lot of skill to deal with all the emotional stuff that goes involved in it. And as traders, we need to have the quantitative data that show us that our trading strategy, our trading system has an edge, bigger picture, meaning that if I do the things that I'm supposed to do as consistently as as consistently as possible, my strategy should be profitable. And that gives us kind of a bigger picture look. And what happens is when we really lock into that bigger picture look, we don't really care about the everyday stuff. I can win 5 trades in a row and be like, no big deal. I can lose 5 trades in a row and know that it doesn't really have a effect on the bigger outcome. And that puts us in a much more settled mind state. Smaller picture, we also need to be comfortable. We were having a conversation in the live trading room this morning about a trading opportunity and managing our emotional risk. And we were going through the whole process. We analyzed the markets. We're talking about EST, entry, stops, and targets. And when we were talking about the stops portion of it, we were talking about being comfortable with your risk. We need to know our risk before we ever take a trade because that tells us how much we are willing to lose. And in this particular case, we're looking at a trade that had like multiple levels of structure to avoid. And we're like, hey, if you have a really, really small risk right here or a really, really big one, it'll be down here. But you need to be okay with taking that big one. And when we talk about risk, right, we should know exactly what we are willing to lose before we ever enter a trade. You should never be in a surprise. You should never have a surprise loss, right? You should never, unless it's like a wild gap on the weekend or something like that. And before you get scared about gaps, I have a podcast episode on there telling you why you shouldn't be afraid of gaps. I'll hopefully edit this and tell you what number it is in the video version. But aside from something like that, we need to be aware of what we can potentially lose before we ever click that buy or sell button. And that's all due to the pre-trade work that we do. And when we are aware of what we can potentially lose, we need to ask ourselves, well, we should be like this. I say should because I've seen some wild things, right? Traders be wilding sometimes. But if we are in a situation where our risk outweighs our rules and our risk outweighs our comfort zone, we should never push that buy button, right? If I have to be in a trade where for somehow, and again, there's so many steps that you would never actually do this. I don't even understand how it happens aside from reckless gambling, which now that I think about it, makes me understand why this happened. But think about it like this, right? If my max risk per trade, per my money management and position sizing rules is 2%, right? And I'm setting up my trade, my position size should be a size where my risk is only 2%. Right? My risk is 2% because I am comfortable with 2% max. And I know before ever entering the trade that, hey, I could lose 2%. If you have a risk that's a little bit bigger, like 5%, and that's outside of your zone, right? You should never even get to the point where you're entering a trade with that much risk, right? Aside from the revenge trading. And I guess that's what happens with revenge trading, right? You lose a trade where you risk 2%. Now all of a sudden you got to make it up. So you're like, hey, let's double the position size and make more from it. And then you lose even more and it snowballs and snowballs and snowballs. Another great podcast episode or YouTube video as well. Man, I wish I kind of knew this before I started talking, was one where we talk about, I think it's called the max drawdown recovery. It's actually a chart I share that show you as you get into a drawdown, how much more you have to make just to get back up to break even. But staying on track here, right? We should never be in a position where we risk more than what we're comfortable risking. And if we're not comfortable risking a certain amount, we should never be in a trade. So what that means is that every time we take a trade, we should be saying to ourselves, I am willing to lose this amount. Now, this goes back to the expectation thing as well, right? So many traders, just like in real life and other forms, we assume that every trade we take is going to win. Well, my question for you guys is, why would we assume that, right? I just told you about having our numbers, having quantitative data through our back testing that show us kind of what our edge should be, what our win rate should be, what our lose rate should be, what our max drawdown, what's our biggest winning streak, biggest losing streak, all the numbers in the world. In anywhere in that data, does it say that we are a 100% winning trader? No, right? Even if you are a 99% winning trader, you still have some losses in there. So there's no reason for us to expect a win on every single trade. And that's the issue that we get into. We enter a trade, and because we assume that, hey, we did good analysis, it has to win, the market does not care. We can do the best analysis in the world and it can still lose. That's just how trading works. But if we're in a position where we're blinded and we only anticipate win, I'm going to make this much out of there because it's going to go all the way here, all the way there, and then it loses, now we're caught off guard. Now we're in that panic mode. Now we're in that revenge mode where, because we were all the way on one side and we just got whipped to the other side with a difference in expectation, now we're panicking, we're emotional, we're acting before we're thinking, and we start getting ourselves in trouble. I like to think about it like a poker table, for example, or like being at a casino, right? When you're playing poker and you have your chips and you're looking at your hand, right? You put your chips on the table, right? Once those chips are on the table, they are not your chips anymore. However, you only put, hopefully, right? There are some degenerate gamblers out there. You only push the amount of chips forward that you are willing to lose, right? So you've accepted that, hey, I am taking a risk of this much on that. I know I could win and that would be awesome, but I also know that I could lose and I would be okay with that. So we need to be okay with our risk. And if we are okay with our risk, if we have the proper expectations and we are prepared to lose a blank amount of money per trade, all of a sudden, if that trade doesn't go in our favor, we're no longer freaking out. We've kind of already anticipated it, and then we're avoiding that emotional state because it's not a quick whip around from one extreme to the other. We're kind of already over there like, kind of expected this would happen. So I hope that helps you with managing drawdowns. I have a lot more episodes on the topic. Again, just enter Trading Coach Podcast on the Google machine, then type in drawdowns or dealing with losses or whatever topic you're listening to, and stuff will pop up. I appreciate you guys joining me as always. Until next time, plan your trade your plan, rate, subscribe, like, review, all the stuff that makes this podcast go yay, whatever that means. And I'll see you guys next episode.